All right. Good morning, landlords. I'm excited for today's training. So I want to welcome you in this morning. And I say this morning because this is the second time I'm recording this. We had a little glitch on the recording when we did our live training yesterday evening. So I'm re-recording this for the group. Hopefully everything goes well this time and we can get this on the classroom so that everybody can enjoy it later. So tonight or this morning, we're talking about multifamily investing, specifically for beginners who are looking to either get started or sharpen their foundation. My goal here is pretty simple. I want to give you the framework so you can actually see how these deals work, see some of the ones that we've done, how the process works, the things you need to look out for, the things you have to execute on, and then you can decide if you want to jump in as an active investor or even potentially partner with us on some of these deals that we'll have in the future. So, without further ado, who am I? So, real quickly about me, my name is Cody Jernell. For those who have not met me yet, I was a former D1 football player. Kind of wandered around after my stab at trying to get into the NFL and league, played overseas for a few years, and then really just didn't know what I wanted to do after that. Like most athletes, that was my world for probably 15 years of my life. And looking to switch gears, I really just didn't have a lot of direction. So went into training. I was helping other athletes try and reach their goals, and finally ran across Rich Dad Poor Dad. So the Purple Bible, investors like to call it, because that's how a lot of people get started on their journey. And then got my license in 2017 because I figured working on the job was probably the easiest way to learn and make some money. That rolled into the COVID era and low rates and prices, so kind of timed that pretty well. Started to pick up my own investments, which was the goal all along. And now, fast forward to 2025, and we own 50 plus doors across both single and multifamily. Have closed hundreds of deals internally and with clients, and now own a full service real estate investing firm called Haven Management Group. And we do sales, management, construction, and investment services all under the Haven brand. Everything that I wish was built whenever I started getting into real estate investing, we're trying to build now to make it easier for new and seasoned investors to either get into the game or scale what they've done already. Um, so with that said, tonight's agenda, or I keep saying tonight, but today's agenda, I want to keep it simple. This is going to be a beginner's framework. So, we'll do some deep dives later on, but wanted to give really the overall shell of what multifamily investing is, what it takes to be successful in it. So we're going to talk about what is multifamily, define it, how to find multifamily, which is super important, how to buy it, how to operate multifamily, and then go through some case studies. And obviously, we'll have some questions at the end if anybody wants to speak up. Now, I want to hit pause for just a second before we move forward. I want to share something that I used to keep pretty private, but I've shifted my view on here recently. And for a long time, I kind of avoided having this conversation in public. But my one and only disclaimer today is everything I'm about to show you, every case study, every win, it's 100% not me boasting about my successes. I've been raised up to very high levels of success at multiple times in my life. And every time that my ego has gotten in the way and I have stopped giving my glory to God, I've been humbled almost every single time. So it doesn't bother me to tell you guys that every piece of success that I experience now has only been possible through my faith and the journey that have had with Jesus Christ. So that's how I'll operate now, and that's how I'll continue to operate. And I'll also say, if you ever want to talk about faith, which is something you need in this industry, I'm here to talk. I've been no saint by any means. So if you've been through the dark places and you're making your way back or you're still there, just know I'm here. I know what that road feels like. You can always reach out to me and talk and work through some things. So with that said, let's talk some multifamily now. So here are a few of our projects that we've done here locally. I'll go through these a little bit more detail as we go along. A couple of these are in Radford. They're a little bit different situations every time we get into a deal, just how we structure them. But this is some of the finished product that you'll see. And I'll show you the beginning stages of these as well. When we take something from, honestly, from finding the deal to underwriting it to acquisition to renovations to leasing it out with our management company and then operating it on the back end. So excited to show you guys those as we go along. So why multifamily in the first place? For me, there are four really big reasons for that. First one being that there are multiple income streams under one roof. It certainly helps out with operations and things along those lines. And then the tax advantages of multifamily are huge. You have cost segregation studies, you have depreciation, you've got tons of things that you're able to do with these buildings that don't quite translate over to single family housing anymore. You also have forced appreciation. You can create value at exponential rates compared to single family homes. It comes down to the cap rate and stuff like that we'll get into here shortly. And you can scale faster than single family. It's great having things under one roof, but imagine having 20 doors under one roof and you can up the rent by $50 per door. That increase in income over 20 doors is exponentially higher than what you would be able to do with a single family home. And the way that multifamily is valued, that exponential return on bumping rents up even has a higher compounding effect in the value of the property. So we'll get into that a little bit here, but those are the four main reasons multifamily is, one of the best ways to really, really put the pedal down on building your net worth and cash flow and trying to get to that freedom goal that a lot of us have. So for me personally, I learned quickly that managing one roof, with 4 tenants is a lot better than managing 4 roofs with 4 tenants. It's just more efficient, it's more scalable, and the wealth building happens a lot faster. So let's define what we mean when we say multifamily, because that means a lot of different things to a lot of different people. So, a lot of times you'll hear people talk about multifamily and they're talking about duplexes, triplexes, quads. And, technically you could say that because it has more than one door. But when it comes to a lender or the government or really just how real estate is viewed in general, anything from 1 to 4 units is still considered residential real estate. So you can use conventional loans on those. You can use FHA financing to purchase up to a 4-unit building as long as you live in one of them for up to a year. And there's a lot more buyers in that market. So it has its own set of perks. A lot more people can get financing, which means there's a lot more buyers, but it's treated more like traditional real estate. And I will go into what I mean by that here shortly. Anything 5 units or above are considered multifamily, commercial. And this for me is where it gets really fun because the value is based on performance, not just comps. So if you've ever bought a single family house, you know that the appraiser will pull sales from around the area, things that have sold that are similar. He'll kind of weight the value of the similarities of it. And that's how he'll get into what your property is worth. Now, multifamily, they do a little bit of that, but it's more based on your NOI or your net operating income. So that is what you receive after all of the operating all the operating income and all the operating expenses are taken out. So you can actually force that value based on how you operate the property, which is pretty cool. The banks care with multifamily more about the NOI, like I mentioned, cap rates, which I'll explain shortly. The debt service coverage ratio and the cash flow, not whether the property down the street sold for more. So that makes multifamily a lot more powerful. You have the ability to directly force the value, and it can be an exponentially higher number than what you'd be able to get in a single family situation. So some key terms. We mentioned NOI, that stands for net operating income. This basically means that after you've accounted for all the property income annually, and then taking out all the operating expenses without counting your debt and your taxes, that gives you your net operating income for the property. And that's a super big, super important number that you will use to value multifamily real estate. And you're always wanting to keep an eye on your NOI and how the decisions that you're making through operations are affecting it, either for good or for bad, because that is the main driver for the value of a multifamily property. So we mentioned also cap rate. Cap rate is basically your expected return on the investment. So you've probably heard of properties being a 7 cap, or maybe in COVID era you heard that properties that were a 4 cap. So basically that means that's your return on investment. There's even properties that go 10 to 12 cap, but the way that scale works is essentially, the higher the price and the higher the value of, or the higher the asset class of the property, the lower your cap rate's going to be. So you can think a safer investment usually costs more. It usually doesn't have as much maintenance. You usually know that your tenant base is going to be there. Maybe they're paying more in rent, so it's a safer investment. Well, with those investments, because it's more turnkey, it's less risk, you're going to have a lower return most of the time. So higher class properties, class A, class B, things that have very little turnover or are in a very good market that has a lot of demand for rent, they're usually going to have a lower cap rate. You're going to have a lower return because your risk is also lower. Now, when you start getting into higher cap rates, a lot of times that means that the property is riskier. It needs a lot more work. There's a lot more vacancy. There's more evictions. There's more tenant turnover. It's not in quite a good area. So you have to incentivize yourself or a potential buyer to put money into that project by having a higher cap rate. When you're looking at your cap rate and how your NOI plays into it, you take that NOI and you divide it by the percentage of the cap rate to the decimal point. So if you have $100,000 in NOI before your taxes and your debt come out, and you divide it by, let's say it's a 7 cap, divided by 0.07. I'll do the quick math for you real quick. So 100,000 divided by a cap rate of 0.07, then your value is 1.428571. So that at a 7 cap, $100,000 net operating income, the value of the property is about 1.4 million, 1.43 million if you want to round up. Now, let's say this is a much riskier investment. It needs a lot of value add. It needs a lot of construction costs. So they're selling this as a 12 cap. So $100,000 divided by 0.12 brings the price down to 833,000. So you can think about it this way. The price goes down when the cap rate goes up because you're getting a higher return. You can't get a higher return if the price goes up with the cap rate. So it's an inverse relationship there. On the flip of the coin, $100,000, and it's in a super good neighborhood. There's always tenants. The rent is higher. There's very little turnover. Let's say it's a 4 cap. You're going to sell that property for a higher value. So 100,000 divided by 0.04 is 2.5 million. So you can see kind of how that cap rate can adjust the price, from a $2.5 million property all the way down to an $800,000 property, depending on the class, the returns that are expected, and the average cap rate for the area. So probably spend enough time on that for now. We can deep dive into that later. But then the third term that we really need to know when we're valuing and talking about multifamily is the debt service coverage ratio. So we mentioned in the NOI calculation that we're not accounting for debt and taxes. And the reason being is because every investor that comes to the table has a different down payment, has a different financing structure, has a different way to finance the property. But the property still performs the same no matter what. So if you have somebody come and pay cash for it, it shouldn't change the value of the property of somebody who's going and getting a loan for 80% loan to value. That obviously their returns are going to be different from you, but from you, the seller, or you, the property owner, that value is not going to be based on what someone else's debt is. So that's where the debt service coverage ratio comes into play. It kind of makes up for not accounting for that on the NOI. So debt service coverage ratio essentially stands for your debt service, which is how much you pay annually on the mortgage that you do have. So you'll take your NOI, let's say that $100,000, and you've got $80,000 worth of debt that you pay every year. You'll do $100,000 divided by that debt service, gives you your debt service coverage ratio, which in that scenario will be 1.25. Most banks want to see between a 1.2 and higher, 1.3 and higher in some markets. But essentially what that tells them is that for every dollar that you're spending on the mortgage, you're bringing in $1.25 or $1.3. So you got a 25% buffer, 25% buffer in your operating costs before you start to not be able to pay your mortgage. So that's what they want to see. That's the reason that they account for the debt service coverage ratio. They want to know, whenever I give you this loan, do you have enough income after expenses coming in to cover the payment on the loan? And they want to make sure you have a 20% or higher buffer on that. The fourth one, vacancy, that one's pretty straightforward. Everyone knows that just is the amount of units that are not rented versus the amount of total units that are available. So that one's pretty simple. Your T12 or your T6, that's going to be something super important to pay attention to or to ask for during underwriting. And essentially, it's just almost like a P&L for a business. So T6 is just the trailing 6 months of actual financial performance of the property. And I say actual because I mean, those are the actual numbers. A lot of times you'll get pro formas from brokers if they've got a property on the market or projected rents for a property. They're showing you what it could be, but we don't purchase based on what it could be. We purchase based on what it is now. So you want to get that T6, at least a T6. You want to ask for a T12. Not everybody has it all the way back to 12 months. They should, but we kind of have to deal with what we got. So you take that T12 or T6 and you verify everything that you've run in your calculations on your pro forma and what the broker and owner have told you. If you start to see discrepancies or when you get good at it, you can start to mark out some red flags, like this property hasn't had any maintenance in the last 12 months. What's going on there? Are they misclassifying that? It looks like there's really high turnover in certain areas or certain times of the year, or it looks like the owners are still paying for all of this, all the utility expenses and other expenses. Are those built into the rents that I'm seeing? Is that why the rents look higher than what they are? So you really need to take this document and sift through it and try and do your detective work to figure out if what the claims are made are true. So those are some key terms. We'll be using those as we go throughout the rest of this and digging into in later. So underwriting, let's start there. So I have a pretty simple framework when it comes to underwriting. Once you get into it, you start to get into the weeds and a lot of there's a lot of intricacies once you're in it. But as far as just an overall underwriting framework, the first thing that we do with our pro forma calculator, which we built internally and is available in our school group in the investor toolkit that we've got, but it's pretty robust but it's also simple, which is why I like it. I've done a lot of underwriting softwares and there's too much going on. But the first thing we do is take that T6, T12, and we put all the income in, we put all the expenses in based on the current situation. I can't stress that enough. Do not use numbers yet that are not actual numbers. We have to base the property's performance on what it's done over the last 6 to 12 months or even 3 years, not what it can do in the future. We will account for that, but not upfront. So you plug all that stuff in, you find your current value using your pro forma. And then as you're going through that T6, T12, like we mentioned, you want to identify some value add levers. That could be, small renovations, raising rents, lowering expenses with vendors, passing off utility income to tenants, making leases more efficient, making leases on a longer time frame to reduce turnover, things like that are all value add levers that will affect that NOI, which in turn affects your value at the end because of the way that the cap rate's calculated. So keep that in mind. And then third step, we have the current value. We've got our identified value add levers, and then we start to build out that projected pro forma of value into the future. So this is what a lot of brokers give you up front. They want you to run your initial numbers off that, but we're going to run those at the third step. So we take into account raising rents. We take into account lowering expenses. We take into account making leases longer term so that vacancy rate might go from a 15% down to an 8 or a 9, and how that affects your NOI at the end of the day. So then we plug those numbers into the pro forma. We see what the new projected net operating income is. We run that with our cap rate. We run that with our debt service. And then we see what that value is projected to be after we execute our plan. So that's where number 4 comes in, creating the business plan. This is probably the thing that I see most investors skimp on or just not do at all, is taking these first 3 steps that you've done and putting it into an actionable business plan or playbook, or whatever you want to call it. But you've got to have something to show and guidelines to follow as you're going through these. Now, like most business plans, if you've ever done a startup or a business, you have this initial document. This is everything that we're expecting. Things can change. You can even kind of deviate from that business plan, but you need to go through the mental exercise of, here's what it currently looks like. Here's what we're going to do to the property. We're going to adjust income up. We're going to do some renovations. We're going to cut expenses. We're going to get a good team in place, which is the second part of that business plan. Who is going to execute this? Is it all me? Do I have a property manager in place? Do I have a general contractor that's going to do all the work? What does my vendor team look like? What does my general partner and limited partner team look like? Are we spreading out tasks along the 4 of us? What's the experience level of everyone? And this plan really turns into your playbook when you go into a property, and it's also what you use to take to the lender to try and get your financing lined up. If you can show up with a solid game plan, you show them what the current value is, what you're planning on purchasing it at, what you're planning on executing and doing to the property, and what's going to be worth at the end of the day, they're going to be 90 to 100% more likely to give you that loan versus you just coming in and saying, hey, these are my thoughts. This is what I'm thinking. Like, no, you spend the time to put this on paper and show the team that's going to execute it with Gantt charts and freaking, timelines and everything. Even if they're all projections, it shows that you've gone through the mental exercise and that you actually have a plan to fall back on as you execute this thing. So I can't stress that piece enough. And we also have some templates in that toolkit of business plans that we've done for lenders in the past, if you want to grab that after the presentation. So wanted to give you an example of that pro forma that I mentioned. This is kind of a screenshotted piece. This is more of like a robust kind of long Excel list of a pro forma, but you get the gist of this. So first thing we have, and don't worry about these numbers adding up because there's actually building 3 and building 4 that I wasn't able to show on this, but you can see the ones in yellow that we have, those are currently leased out. We've got our monthly rent, we've got our utility income coming in, got our annual rent. Purple is in construction at the moment. This is actually a property that we're in the middle of doing. Red, they are unleased right now and probably not renovated yet. So that just gives us a little bit of, an idea of, okay, here's our monthly income at current value. This is important. This is our current pro forma, the first step here, find the current value. So we're looking at a current snapshot. This is the performance income-wise. Total income is there at the bottom, 247,980. And then we have our expenses. So you can see we've got, a percentage coming out for the management fees. Vacancy in this scenario is actually already accounted for. So if you've got property that has, empty units, or it's 30% vacancy, it's kind of already built into the numbers that you're pulling. So that changes when you go to do your pro forma down the road. But you can see here, counting expenses, insurance expenses, repairs and maintenance, trash services, APCO. So big thing that you can see here is there's a lot of utility expense. So that's on the shoulders of the owners right now. And you want to, that's just a ding ding in your head. Hey, there might be some value add opportunity here if we can make these leases more efficient. Tenants expect to pay their own utilities. It's just a commonplace factor now. So it's not that tough to get them to agree to that in a new lease. But as you can see, after income minus expenses, that brings our net operating income down to about $89,000. So in this area, cap rates are typically about a 7% cap rate. You can do some comps and pull some recent sales and try and maybe even talk to some brokers about what an average cap rate for a property like this in this area goes for. And typically right now, 6.5%, 7%, maybe even 8% is pretty common for properties that have some value add and need some work. So we run a lot of our stuff at a 7% just because it's kind of an average. But if you take that NOI and you divide it by 0.07, that gives you $1.27 million valuation, just so you can kind of see how those figures work. Don't worry about the debt service ratio right now because this is the current owner's loan. We were kind of running some scenarios with them, but that's how that pro forma works, how you back into those numbers with your NOI, things along those lines, using the cap rate to find what your current value is. And this one was right around $1.27, $1.3 million. So then we have identified some value add levers. We decided we're going to try and raise rents, obviously just get the empty units fixed up and rent it out. And then lower the expenses on the seller side. So we take that initial number, that 1.27, we come back in here and we say, hey, once it's all, the project's finished, we have it all leased out, this is what we can get for those units monthly. Here's what it looks like annually. We add all that up. That raises our total income, our gross income to $361,800 from, what was the last one? 247. Yeah, 247 to 361. So that's, pretty drastic increase, almost $100,000. Second thing we do is with the value, we come through and we redo our expense pro forma. So one thing that we like to do once a property stabilizes is actually lower our management fee. So that has gotten us through the tough part of managing these properties and helps the owner out. We have more properties that are full and less maintenance because they've done all the work. So we're okay with dropping that management fee down a little bit because it's a little bit easier to manage. So then we have to take into account our vacancy. Accounting should stay the same. Insurance should stay the same. But big factor here, look at the value add from reducing the owner expenses on the utilities. That's huge. So we went from a $158,000 annual expenses to $121,000 annual expenses just from removing the utility expenses, or most of the utility expenses, from the owner's plate. So now we take that new NOI. Remember, we were at 89,000 before. Now we're up to 240,000, and we take that and divide it by 7.07% or a 7% cap rate, and this is our new value. So this is what I'm talking about with the magic of multifamily. Really treating this like a business and seeing the multiple effects of the cap rate is pretty amazing to watch. So that gives us a new value at 3.5. Now, this is where the debt service coverage ratio really comes into play, because just because the value is at 3.4, 3.5 doesn't mean the bank is going to come and give you a loan for that amount. They would be silly to do that, because if you run how much it costs for a loan at 3.5, I can almost guarantee you're going to be paying more than what you're getting in your NOI. So they're not going to give you a loan that you can't pay back. So that's where that debt service coverage ratio comes into play. With this one, we were buying in at 1.5. We'll go into the details later, but we ran our new loan at 2.2 million, and that gives us, at 7% for 25 years, that gives us a monthly payment of about 15,550 annual payment, a little bit over 186,000. We go back to the NOI and we divide the NOI by the debt service, and that gives us our debt service coverage ratio. So 1.29, pretty good in the bank's eyes. They want to see that 1.2 or above. So basically here, the bank knows that for every dollar that we pay out in the mortgage, we're receiving $1.3 in income. So we have a 30% buffer there for, rents to go down or vacancies to go up or expenses to creep up, to where, we can still cover that rent payment. 30% is a pretty good buffer. So that's the magic of multifamily. I wanted to walk you through a little bit how we use the pro forma, current value pro forma, identifying the value add levers by looking at these numbers, looking at the T6, T12s, and then really creating that new stabilized, best case scenario with some contingency in there. You don't want to just fluff your numbers to make it work. You have to be real about the numbers, bake some additional costs in there, because there always are some, and then see how that falls. You want to stress test this, and then you go and build your business plan. Like I said, we got templates for that in the toolkit, and we will move on from that from here. So now we know what to do when we find a deal. How do we go find them? So there's multiple ways, really, to make this work. A lot of it is, relationships. I mean, the best deals rarely make it to the websites, to be quite honest with you. There are still deals out there. We've bought plenty that are on the market. But when you really find those holy crap deals, those are typically coming from your relationships with other people in the industry. So that could be brokers. It could be networking with other agents. It could be networking with property managers, contractors, people that are in the game, that are boots on the ground, first ones to know, that deal with the owners. They know the properties. You want to be running in those circles with those people. So another thing is the direct to seller marketing. So we'll get into this, but that's basically, how do I get directly in touch with the seller of a property that I've identified that I think could be a good opportunity. There's multiple ways to do that. And then, like we mentioned, there's the online platforms, specifically for commercial multifamily real estate. So everybody knows Zillow, everybody knows realtor.com. But these are more geared towards, people in the commercial space or multifamily space. So dive into those just a little bit further here. So the networking side, brokers, sellers, investors, brokers and agents obviously have a really good in with property owners. They either sold them the property, or they've, done their marketing to get in front of those people and build relationships. And I'll make a distinction here. These types of brokers are not the same brokers that you see selling grandma's house or selling the house in your neighborhood. A lot of times, they can do a little bit of both, but a lot of times you will have brokers and agents that are specifically, or have kind of more authority in the investing space, whether it be multifamily or fix and flips or whatever it is. But you probably want to start with those brokers. You want to let them know what you're doing, what you're interested in, what your buy box is. If you don't know what your buy box is, go back to one of our previous trainings where we talk about that. And let them know, that you're interested in properties like that. They will start to send you stuff, but you have to be serious about analyzing them and not wasting their time. Being a broker myself, we get a lot of tire kickers calling, wanting to get in the game, or say, hey, I want to do this, I want to do that. You'll send them deals, you'll never hear from them again. Even if you don't like the deal, you need to thank them for the deal, and give them a reason why it didn't work for you. So show them that you did your homework, you went through it, you asked them questions. If it doesn't quite fit, doesn't have enough value add, price is a little bit too high, you need to let them know that, so that they can tailor what they're doing and send you again. And they also know that you're taking the information that you gave them. That's super important. A lot of people Don't stress that enough. But the other thing is property managers. We do property management. We're boots on the ground every day, managing, touching these properties. We know exactly how they perform. We know a lot about our owners and sellers, whether they're in a tough financial situation and they don't have the funds to, put back into the property and it's starting to fall apart and they're looking at how to exit, but they don't know what to do. Property managers know a lot of that stuff because they touch base with those owners every week. Commercial loan officers are the same. They're doing the loans. They've got great relationships with investors. And on top of that, a lot of times they'll know if a property is about to go in default or they haven't been hitting the metrics that they need for that the bank has set forth for the loan. So if they know something's coming up or somebody's going into bankruptcy or they've got a property that's behind on mortgage payments and they're not able to pay it, they would be a great resource to have to be able to talk to and say, hey, do you have anybody that's upside down that needs help or an infusion of capital or, is about to go into foreclosure, and then we can swoop in and try and save them. Those relationships are great to have. Plus, you obviously want commercial loan contacts if you're trying to purchase commercial property. They're going to help you buy and execute your business plan with the funds that you need. So that's obviously a great one to network with as well. Real estate attorneys and closing companies. These guys close deals for investors all the time. They can also pull you lists and just keep you up to date on what's happening in the market, who might be interested in selling and how they want to need to structure it, and things from there. So, other investors are a great thing too. There's a lot of meetups and online groups, like ours, where investors kind of come to play, and you want to find where all these people hang out. So, whether it's meetups, whether it's Chamber of Commerce, whether it's the local pub, like just figure out where these guys are. The last one is usually my favorite, but if you can get in front of them, create a relationship, don't be too salesy up front. Just let them know that what you're working on and see how you can help them, not just how they can help you. Then that's a good relationship moving forward. And you will be surprised how many people start to call you or text you whenever a deal comes up. So the other thing is direct to seller. So, one of my favorite things to do if I've got a few hours, which is very rare these days, but if I've got a few hours on the weekend or in the morning or in between appointments, I will get out my notebook and just drive around a town or around a city and literally just look for meters on the sides of buildings. Because, if you see 6 meters on the side of a building, there's at least 5 properties in there. One of those meters might be like common area stuff, but it's a good thing to do. You want to obviously write down the things that fit your buy box. If you're trying to find value add multifamily, you're not going to make a list of properties that are A class that look like they've been updated or they were built 3 years ago. Just doesn't fit your buy box, so you don't want to waste your time on that. If you're looking for value add, some of the things to definitely keep an eye out for: tall grass, just poor maintenance, or poor landscaping in general. Typically means that either the property manager or the owner's not spending their time there, and it's really a good indicator to kind of know what the rest of the property is being operated like as well. You can look for signs of maintenance, pressure washing from the outside, if there's broken windows, if there's window units. A lot of times that means that there's no heat pump at the property or the heat pumps aren't functioning, which means there's probably some updates that can be done. Just because there's not a heat pump doesn't mean that it hasn't been updated, but a lot of time that kind of goes hand in hand. You can kind of extrapolate or, project what the inside is going to look like as well from that. And then the other thing is missing electric meters. So like we said, if you drive by an apartment building, there's 12 meter spaces, but only 6 of them actually have meters in them. You can probably assume that there's at least 5 or 6 empty units in that. The owner is either strapped for cash and not able to do the renovations to get those full, or they're just not getting enough income in, clearly not getting the maximum amount of income in. So there's probably a lot of value add that can be done there. That list is endless on what you can kind of check off if you see, roofs, gutters, like parking, like anything that you see from the outside. You have to start to kind of make some assumptions, and then, mark that on your list and move from there. So the other thing this kind of can go hand in hand with driving for dollars, but direct mail campaigns, like we said, pick your buy box, know what your criteria is, generate a list with addresses and names of properties that are interested, and then go farm it. And, when we say farm it, we mean send mailers. There's not a one-off thing. You have to do it multiple times for it to work out. But you want to be top of mind in those sellers' minds whenever they do decide that they want to sell. Most likely they're not going to call you from your first mailer and say, "Hey, I saw it. I'd love to sell you the property." It can happen, but most of the time it's called farming for a reason. You're planting seeds and you're going back and germinating those seeds with additional mail campaigns, calls, other ways to get in front of these guys. And then whenever it sprouts and grows, hopefully they're the ones that call you first whenever there's an opportunity. So the last thing I can say about direct to seller, this kind of ties in with the networking, but just make sure that you're vocal about what you do. Talk to family members, talk to friends, talk to people that you work with and around, other people in the industry. They tell us all the time, do not be a secret agent. So you want people to know that you're an agent or a broker. If not, they're not going to call you. Same thing for this. If they don't know that you're interested in multifamily or that you do deals with a group that buys multifamily, even if you're not the main operator, then they're not going to call you first. That's just not, it's just human nature. They're going to call the first person that comes to their mind. So you want to be that person. So we mentioned some online platforms. This is not an end all be all, but some of the ones that I use most frequently. We mentioned the Zillows and the Realtor.coms. Well, these listing sites are geared specifically towards multifamily and commercial platforms. So LoopNet, Crexy, just like your Realtor.com, just like Homes.com, but it's for multifamily and commercial property. 10X is similar, but it's a auction website. So it's a good place to find deals, but you just have to make sure that you're prepared if you find something on there to meet the terms of what those sites or those auction types require. So a lot of times it's more of a down payment up front. Sometimes you can't even get into the property to look around. So you really got to have kind of your systems in place and know that it's going to be a good deal and fit your criteria. Lead gen sites like PropStream and Deal Machine. These are apps that I use to build those lists that we talked about and driving for dollars lists. So they have maps built in to these softwares or these platforms, and you can literally drive around. And if you identify a property you think looks like a good value add opportunity, you can click on that parcel from the map. It'll pull up information on the property, when it was last sold, who owns it, how much they have on their mortgage. Sometimes if they're tax delinquent, there's a ton of information that they scrape from online. Don't ask me how they get it because I'm not sure. But you can also, a lot of times, if you have a paid version, you can click on the owner's name or the LLC. You can see everything else that they own in the area. A lot of times it'll give you some phone numbers that are associated with them. They'll give you some emails that are associated with them. I think all that stuff comes from, like GIS and post office and things like that. But super useful tool for me, totally worth the money. When I'm building lists, you can pre-build lists. So if you say I'm looking for 10 plus unit buildings in Richmond, Virginia, that the owners have had for over 10 years and the owners live in a different state. Well, it'll pull you a full list of all those properties. And then what I do is I will get on Google Maps and I'll go through every single address and just identify that property. So instead of driving around, wasting gas doing it, I kind of have this first step of, hey, let me see which properties meet my criteria visually from online. If it's questionable, then I'll make a little mark. If it's totally, I think it's going to be an opportunity, I'll do that. If it looks like it was built 3 years ago or just is in an area that I'm not interested in, I'll totally mark it off so I don't waste my time. But there's a lot of ways to use those apps to further your your lead gen or the property base that you're looking for. And then the last thing are groups. I've got our group here, the Haven Investor Network. It's a school group, but there are deals in groups like this, not just on school, Facebook groups, other online platforms that are like that, where investors come to mingle for a reason. They're looking for deals. They're looking for education. They're looking for collaboration. They're looking for lenders. They're looking for brokers that have deals. They're looking for people that do construction. So these are great groups to get in. If you're not in ours already, totally not a shill, but you should get in there. We're trying to do some big things with that group. So moving on from there, let's talk about financing a little bit. So we mentioned residential versus commercial loans, kind of how the banks view those differently. So one of the biggest things on financing, it's always usually the biggest hurdle for a lot of people. But the truth is, once you understand how lenders look at multifamily versus single family, it gets a lot simpler for you. So those commercial loans, 5+ properties, those are based on the performance and the debt service ratio, like we mentioned. And the bank they don't disregard your credit score here. So let me get that clear. But a lot of times they will give you the loan based on your business plan and the performance of the property. So if you've got some dings or your credit's not as good, you don't get qualified like you do with the when you go to get a mortgage on your house. Sometimes depending on the situation, you don't even have to come up with a bunch of tax returns. They're definitely not going through all of your bank statements and asking you what this charge was or what that charge was, which is a huge pain in the ass for everybody. I hate doing single family mortgage applications for those reasons, especially when you have 12 different LLCs and they've got to go through each one and validate and see what the bank statement is for each one and see what the cash reserves for each LLC is and what it's tied to and what it is. It's just a huge headache. So commercial gets around all of that. They're worried about the property and the operator of the property. A lot of times you will have to be the guarantor of this. So they will take into account your financial situation. A lot of times they want a personal financial statement, which shows all your assets, all your liabilities, your income, your other real estate, your cars, your house, all of that. But they'll use that as opposed to using all your tax and bank statements and all that. So it makes it a lot more simple. They just want to know that property, if for some reason you go bankrupt, they can take that property over and it's still going to operate the same way that it was without you there. So that's the beauty of that. The other thing is private money and joint venture partnerships are super common in commercial real estate. A lot of times the people that are selling those properties probably bought them with some sort of private money or JV partnership. So essentially what that means is there's other investors out there that want to tackle larger properties like this. So it's really common to pool money together, do a joint venture to go and execute a business plan like this. It helps because there's a lot more meat on the bone, if you will. There's a lot more cash flow to be had. There's a lot more appreciation that you can feel comfortable with only taking 30% of this deal because you're raising the value by $2 million, but you don't have to come out of pocket $500,000 personally to get it done. You can go find 4 or 5 different investors and all tackle this at one time. So that's a huge also kind of value to financing multifamily properties. Is it's more of a team sport. You don't have to pay for everything yourself or have that burden by yourself. And then the last one, which is kind of my favorite, I got into real estate. I didn't have a ton of money, so I had to learn real fast all the creative strategies that you can do to try and acquire and build your net worth, without necessarily getting a bank loan. And like I said, a lot of these investors, they used either private money or some sort of like seller financing or some sort of creative strategy to probably purchase these whenever they had it. They're very, owners a lot of times are very tax savvy. They don't want to pay the government any more tax than they have to. So if they've got a property listed or they're interested in selling it, there's a lot more flexibility on saying, hey, I don't have the money for the down payment. Again, here's my business plan that I put together that comes up throughout the whole process here. So that's why I harp on that so much. Here's the business plan for this property. I'm not going to give it to you because I don't want you to do it, but I can execute this, but I don't have the money for the down payment. Mr. Seller, you want $1 million. I need $250,000 to be able to purchase it. Can I get a loan for, 750 and you owner finance me 200,000 of the 250? I'll put 50,000 up. You owner finance another note for the 200,000, and then the bank is going to give you the money from the loan that I'm taking out of 750,000. And they say, great, that's $200,000 that I don't have to get taxed on right away. We can spread it out over a 10, 15, 20-year term, maybe put a balloon payment on it after you've done your business plan. You can refinance and pay me back in 5 years. There's endless possibilities there. But the great thing about multifamily commercial properties is these sellers are much more willing to try and make a deal work. Again, because there's more meat on the bone, and they're trying to just make the deal work. So awesome way to do it. We've done that multiple times, and it's worked out well. So I kind of went through all this without knowing that I had this next slide here. So we'll kind of skip over that. But, just to recap, financing differences, the property is approved on the property performance, not your personal financial situation. It has some weight on it, but it's more about the property than anything. It's valued like a business. They look at the NOI. They use the cap rate as basically a multiple of that to find the value of the property. The debt service coverage ratio is the main metric that the bank cares about. They want that to be at or above 1.2x, which means, again, for every 120 or for every dollar that you pay out towards the debt, you've got 120 coming in income to cover it. And then seller financing or creative strategies are more common in this world. So let's get into the kind of the management and the value add component. We've talked about a few of the levers, but one of the critical and most key things in a project being successful is the management team that executes the project and the ongoing operations. So, this business plan, execution plan is one step, but then you have to make sure that that property operates the way that you're saying it's going to, and profitably after that stabilization period and the refinance happens. So a lot of those systems come down to leasing. Obviously this is a lot of property management expertise, asset management expertise. So leasing, the rent collection, making sure people pay on time, making sure we have a way for them to pay depending on their situation. Record keeping is super important. We talked earlier about, as a buyer, you want to see that T6, T12 and be able to really see what's going on with the property. Can't tell you how many times I've tried to sell deals for clients and they don't have the proper records in place, and buyers just aren't interested because they don't know what they're getting themselves into. They don't want to take that extra risk of something coming up that they weren't aware of that completely changes the scope of the deal just because the owner didn't keep proper records. So that is a super important piece for making sure the value of your property stays where it needs to be. And then obviously maintenance and, renovations, turns, things along those lines. Those are all systems that, yes, they get it from value add to stabilization, but they're also super important in the ongoing operations and making sure that the property is, doesn't fall behind on maintenance. There's not big things that happen. The roof doesn't deteriorate before somebody catches it. Things along those lines to keep the property, value high as you operate it and until you exit as well. Some of those value add levers that we've identified: unit upgrades, raising the rents on, gradually. We try and do it gradually if there's tenants in place. If there's a vacancy and we've renovated a unit, sure, bump the rent up to market rent. But if you've got people in place, we want to do that incrementally to keep that vacancy rate down. Utility bill backs, we talked about that. That can be a huge savings, 100,000 plus on some bigger properties. And then additional income sources. This is something that a lot of people skip over. Can you add laundry? If there's not any in the units, can you add a space for laundry? Is there storage on the property that you could rent out? Do some of these have garages that are, attached to multi-unit buildings that you could charge for? Parking spaces. those are all kind of components where you can add value to the property by not doing a lot, just using what's already there. But as an asset manager, knowing that, every piece of income that I bring in ups that NOI, and makes it, more valuable on the back end. All right. So let's get into some case studies. I've got two here. If you remember back at the beginning, probably don't even recognize this building, but it was one of the buildings in that case study model that I showed you. Sorry, drinking my coffee. So this was a Radford property that we did. It was a 6-unit building. It looked like this whenever we took over. It was probably 2 blocks from campus. We don't do a lot of student housing, but this opportunity, was one that we couldn't really pass up. So we bought this property at $310,000. It was super distressed. There was graffiti inside. There was animal feces. I think it was animal feces. I hope. Throughout the property, boarded up windows. Pretty easy to see there's a lot of value that can be added here just by driving by the property. So we got in touch with the seller. It was actually a prior broker that we have a relationship with. So that goes back to the networking piece. And we negotiated a deal on this property for $310,000. Clearly when you do your current value pro forma on a property like this, there's really nothing to even base a pro forma off of. So kind of have to look at the market, kind of have to back into the purchase price based on what you do in step 2 and step 3, which here was identify the value add levers. All the value add levers here came from construction, renovations, and leasing. So then we ran that pro forma on the back end. Okay, if we anticipate that we need to spend $450,000 to get this up to snuff and be able to lease out, and we think that we can get $1,400 in rent every month, which was this number, and then we kind of project our expenses using the cap rate that's available in that area. What do we feel like the value of that property could be? So we backed into a $310,000 number. We were a little bit lower than that. We negotiated up, obviously, until we felt like, hey, this is still comfortable for us, and sellers were happy. So we landed on 310. We put about $450,000 into the property. After construction and stabilization, rented it out at $1,400, which is about $100,800 per year. And then got our appraisal, showed the appraiser our pro forma, our numbers, everything that we had, and the bank approved us for a loan of $650,000, which almost took out all of the money that we had in here. So I think we kept like $30,000 a piece. It was a 2-person deal, joint venture on this one. $30,000 a piece to buy a property like this. I'll do that deal all day. So here were the numbers. ARV, the appraisal came back at $1.25 million. So we forced, with our investment and 8 months of construction and another month of leasing, we forced $600,000 worth of equity. Like I said, we ended up with only $30,000 a piece, so $60,000 in this transaction, which is pretty sweet. That's why value add or multifamily to me is like a no-brainer. So when we bought this, we used a short-term rehab loan. The company that we used and the product that they have, they allowed us to do 90% loan to value on the acquisition. So, on a $310,000 property, we had $31,000 plus some closing costs was our initial buy-in. They gave us 100% of the construction, 100% of the construction funds. And then it was a loan for 12 months at 10.5% interest only. So that's, those rehab loans, they're great because you can put a little bit down, but you really have to account for that higher interest rate and it only being interest only and the fact that it's a shorter term. So you got to be really concrete in that business and execution plan and run the books and make sure that you're going to be comfortable with that. But once that was completed, once we got it leased out, we had that appraisal done. It was a $1.25 million appraisal. The bank came in and said, hey, we'll give you a loan for $650,000 at 6.5% on a 25-year term. And they were willing to do that because it showed that our debt service ratio was going to be at a 1.3. Now, we probably could have pushed that up a little bit. Maybe we could have got 670, 680. I don't know what those numbers exactly are to, really stretch this to a 1.2, but I don't like to push the envelope on that too far. It's nice to have some extra buffer. And that 1.3, the higher that number is, the more cash flow that you get in owner distribution. So there's kind of a sliding scale on like how much money can I pull back out versus how much can I kind of leave in there and get more residual income from the property throughout the year. So we left it at 1.3. We were happy with that. So this one was a second case study. This one was a little bit more of a creative deal. And I'll go through the specifics of it shortly, but we went through that pro forma that you saw at the beginning. Part of that pro forma was what we ran on this deal. So we actually agreed to purchase part of the property, and I'll explain that here in a minute, at 1.5 million. Total price was 1.5. We bought in with $300,000 of rehab and operating expenses because this property was actually losing money when we took it over or when we partnered on it. After the rehab, you guys saw in the pro forma, the rent's going to be somewhere around $362,000. That value on the appraised value after they've seen what we've done to the project, executed on our plan, was much higher. But this loan at 2.2 million basically bought us back out and then some on top. So bought in at 1.5, rehabbed it with 300,000. The rents got up to 362. That's before our expenses and everything come out. But with the debt service ratio, the bank was willing to give us a loan for 2.2 million. And that, 1.5 plus 3 is 8 plus another $500,000. We could actually pull all that money out tax free. It's almost like flipping the property, but that's actually a loan. So when you do like the Burr method in multifamily, you could live off that money for a while. At least I could. And that's tax-free money. So that's how the wealthy do it, man. They do projects like this. They pull the money out from a loan. They live off that to lower their actual taxable income, but get big spreads on the back end to be able to either go do more deals or just go on vacation. So this one had a lot of value add. You can see some pictures here what the carpet looked like. This was where a bed was, which is absolutely disgusting. When we came into this one, there were 9 out of the 26 units leased. So vacancy was super high. The previous property managers were running this as like a short-term, midterm rental, which makes no sense in my mind for a 26-unit building. We don't have anywhere near the demand for that many like short-term, midterm rental units in this area. So it caused a lot of vacancy. There was a lot of turnover, a lot of cleaning fees. The owners had to pay their own utilities because they didn't have long-term leases in place. Property managers let the grounds run down. There weren't you can see bushes back here that were grown up. There were trees growing over the balconies that hadn't been pressure washed in I don't know how long. They didn't even have keys to the empty units. So when we were trying to look around, he was like, I don't have keys to probably 15 of these properties. And it was just like, how are you planning on leasing them if you don't have the keys to get in? It was insane. We had to drill out all the locks to get into the property, and then they look like this inside. So just a complete head scratcher. The owners were losing like $100,000 a year for the last couple of years. They booted these guys, almost sued them. Still feel like they probably should have. We came in to take over, and we did our business plan for them up front, something I still do for our management clients. That business plan isn't just for me, it's for them to execute on as well, even though we're doing the work. Came up with the budget, they said it was great, but then a little bit through the process, they started to kind of run out of headway on the funding. So instead, they came back to us and they said, look, we don't know what to do. We can't sell this because it would be a huge loss, especially for the money that we've lost and put into it. We're just kind of at a loss at what to do. And I said, well, I still believe in this business plan. I still feel like this could work. What if our group brought the funds to finish out this project and you let us take over, majority ownership and be the managing member to make all the decisions and run this thing and really get it back up to snuff. So that's where that $1.5 million valuation came in. That was their current loan that they have on the property. So we bought into their current loan, 300,000, executing this deal now. When we get it stabilized, we'll have the appraiser come back in. The value should be somewhere between $3.5 to $4 million at that point, based on the pro forma, and then we can get that new loan at 2.2 million. There you see there the ARV somewhere around 3.4. That's being conservative. So that means, based on what we bought in and based on what it is now, the forced equity is $1.2 million, which is pretty sweet, and less than like a 12-month period. So in this scenario, I just told you we financed creatively with the sellers. We bought in as 60% equity partners, have majority ownership with decision-making powers, and then we will cash out refi after, it says 6 months, but 6 months since we bought in. They've had it for 6 months. We've been running the project for 6 months for them. So technically 12, but we will cash out at a 1.3x debt service coverage ratio at 2.2 million at 7% for 25 years. So we are still cash flowing very well with the $2.2 million loan. We get our 300,000 back out of it. There's another 500,000 that it can either stay in the account, or we can pull out tax-free as a owner distribution, if you will, because it's part of the loan, and like a heck of a return on investment. And then we're going to hold this thing long term. There's even 12 lots behind it that have been subdivided that could be built on down the road that are part of this property, and another 5 acres beside it that a farmer owns that he doesn't have any use for. It's wooded. It's got road frontage. So there's a lot of reasons why we were willing to get in on this deal and not completely buy the sellers out. Plus, it just became a win-win-win for everybody. I mean, they get retirement income, which is what they were interested in. The property is not, underwater anymore. It's gonna be cash flowing. They're going to get residual income from that. The value has appreciated a ton. So when we do sell it down the road, we've got all that equity that we're still sitting on. The delta between the loan amount and the and the new loan, just hard to beat that. So with all that said, the path forward for anybody that's here, if you're just starting out, we talked about the difference between kind of 5 units plus, but it doesn't hurt you. I mean, if you're just starting out, don't be afraid to just buy a single family house. That's the best thing to be able to learn on. There's a huge market to be able to resell it. So, that helps out with the exit plan. But, getting in a duplex, triplex, fourplex is like a good way to get your feet in the game, get your, get some experience under your belt. Maybe only need one partner, maybe you don't need any partners at all while you're figuring it out. And then the second, probably the most important thing is building your team. So you need lenders to be able to execute these deals. You need brokers to be able to find them. You need property managers to be able to execute. You need contractors to be able to execute. Multifamily is not a one-person game. It's a team sport. So you've got to have a good team in place. Was another reason why we started Haven, because the one-stop shop did not exist anywhere, at least around here. I want to build a place where we do sales, management, construction, and structure the JVs or the syndications and joint ventures for our clients. So that's what Haven's trying to build. It was something I wish we had when I got started, but they can come to us. We can help find the deal. We can help manage the construction piece of it. We can help get it leased out and stabilized. And then, we can hold it long-term and then sell it for them at the exit. So it really is like built for investors, by an investor. I'm an active one too. So can't stress that enough, though. It doesn't have to be with us, obviously. But you want a strong property manager. You want a strong either general contractor or a list of vendors of contractors that do those things. You really want at least one good lender, commercial-wise, that you can run deals by, have them stress test it for you, tell them what the financing and bank situation is going to look like. And then, there's multiple other vendors that are part of that process too, but those are the big ones. And then obviously keep learning, taking action. That's why I started the school group. I wanted people to be able to learn. I wanted people to watch what we do, learn from the mistakes that I've made. watch the successes of the group, hopefully get in on get their feet wet either on their own deals or deals with us. And then the last point is grow faster together. So I'm actually working today. I inked a deal, something I've been working on for years now, is finding a way for at least local investors to be able to get in on these deals with us. Like, not going to get into the syndication laws, syndications versus joint ventures, blah, blah, blah. But basically, without being an accredited investor or making this a true joint venture, it's really hard to pool money together from multiple different sources without going to the SEC and labeling a security and doing all that stuff. So I am happy to announce that we have just started building out our own value add multifamily fund. So this is, like I said, something that's been in the works for years now. We finally found a partner, Pocket Properties. They are able to handle all the compliance, SEC paperwork, and things like that to allow us to actually crowdfund real estate. So whether you've got $500 or you've got $500,000, you can get in on these multifamily deals with us and get your feet wet, really see the benefits of some of these 10x ROIs that we're seeing, especially with equity. That's what the plan with this fund is. We're going to find value add multifamily deals. We're going to use the capital that we've raised to go in and execute, make it more comfortable with us. We'll pay less interest because the loans will be shorter. Hopefully we don't sometimes not have to use a loan, but we'll be paying less interest. We can accelerate the value add process, and then when we refinance, we can rewash that money so we can go do as many multifamily deals as possible. So I'm super, super excited about that. Probably have said that enough, but I look forward to being able to present this to the group and the community that we've built. And then, also we mentioned this already, but a lot of these team building things and pieces that you need to make this successful, I have tried to build under the Haven umbrella in a vertically integrated investment company. So we do the sales, we'll do the management, we'll do the construction, we'll do the ongoing, operations of it, and then can help have a successful exit as well. So feel free to call me on that if you've got a project. If you already have property that you feel like could perform better, we'd love to take a look at it. We've got some pretty cool promos going for management right now. And I've always got my eye out for new deals. So excited about that stuff, man. It's been a long journey, and I think it's going to be beneficial for everybody. I can't wait to get people in the game that are not currently investors and just don't have the time. So want to say thank you. Obviously this has been a little bit of a longer piece of content, but it's really just scratching the surface of multifamily. We are going to have an upcoming value add multifamily master course. So taking all the points that I made today, the high level stuff, and really, really digging into them with modules on, full modules on underwriting, full modules on how to present to a lender, full models on how to go out and find properties and get in front of sellers and negotiate deals, how to operate them, how to execute on the construction piece. So that's going to be a huge course that we're building out, still in the works, probably going to take at least a few months, but we're going to have some industry experts help us out with that. It's going to be a really big piece, I think, to help get people, comfortable with making these types of investments themselves. The other thing I mentioned, the calculators, the scripts, the templates for the business plans, even the contracts and the letters of intent and things like that we use, all those live inside the Haven Investor Toolkit in our classroom section in school. And I had $199 value here. Like, it's cost me 10 times that over the last 10 years as I've got these things in place, built them out myself, made mistakes, sourced them from either other masterminds or, just being a broker and having access to forms and contracts and things along those lines. 100% worth more than $499 for you right now while we build it out, which is for a limited time. Once it's full and robust, it'll probably kick back up to that $499 value. We're selling it for $47 right now. So if you really want to start kind of playing with the calculator, you want to start making offers with LOIs, you want to, get the scripts for talking to sellers, this is the best time to buy that thing right now. And it won't be $47 for long. So with all further ado, feel free to reach out to me, whether it's about your, faith, whether it's about investing, whether you got a deal and you just want to, talk it up or stress test some stuff, book a call with me. My Calendly is all over school. Appreciate you guys. Hope this was valuable. Like it, share it, subscribe, and I hope to see you soon. Let's connect. Thanks.